Welcome, everyone, and thank you for joining us for our 2025 Economic and Investment Outlook. We're going to discuss the trends, risks, and opportunities as the new administration takes hold in 2025. I am Jeremy Hutzel. I am the president of Seven Springs Wealth Group, and on the agenda today are going to be topics that I know are top of mind for all of you: inflation, immigration, productivity, interest rates, fiscal policy and the deficit, tax policy, geopolitics, the impact on the financial markets, and really our team's investment outlook as we head into 2025. So, joining me today on this journey through market outlook are Andy Michael, CFA and Chief Investment Officer at Seven Springs Wealth Group, Jenny Wilson, CFP, my partner and a director of financial planning. Matt Parks, CPA, a tax strategist and financial planner. Dennis Carter, a certified financial planner. And Hunter Yarbrough, CPA and certified financial planner. The economic outlook that we're going to dive into today really is going to start with these GDP growth prospects, some unemployment trends, and the key economic indicators. And if you followed any of our communications so far this year, you've probably heard Andy Michael, our Chief Investment Officer, talk about this 224 economy, really where he's coined that term as the 2% inflation rate, the 2% GDP growth, and the 4% unemployment rate. Of course, 224 being the first numerator in all of those figures currently. And what that is really a Goldilocks scenario. In many ways, it's the scenario the Federal Reserve has been aiming for over the last few years. And as we welcome a new administration into Washington, D.C., and the new fiscal policies that come with it, the big question that all investors are facing is what could sustain or derail this 224 economy? And I think Andy is the perfect place to start as we dive into this question. So, Andy, what's on your mind?
The one way I really like to think about this, Jeremy, is thinking about the misery index, which is unemployment plus inflation. And so if we look at this chart here, what you can see is that the misery index is actually near a quarter of century low. We've actually had inflation come down meaningfully, unemployment has remained low. And so what's really on our mind is what risks do we see that could make this misery index spike back up, right? Whether it's high unemployment, high inflation, or even worse, both. But frankly, that'd just be miserable. And so, what we want to think about is how can we keep this misery index low for years to come, or what risks do we see that might could increase it as we look out ahead?
Well, I'd love to not talk about something called the misery index, but I am grateful to hear from you that it's at near all time lows. I think the big thing that's on folks' mind right now is inflation. And as we have pivoted out of the pandemic and some of those high inflation rates that we experienced in 2021 as a result of the stimulus that was needed to re-stimulate the entire global economy, inflation's been on people's minds a lot for the last few years. I know we've had a lot of conversations in our office as well as in the commentary that you've put forth. As we look at the new administration, what are some of the policies that may have an impact on inflation?
Yeah, that's a great question. On the risks to higher inflation, especially with the Trump administration coming in, there's two that really are on top of our minds. One is tariffs and the other is immigration. So let's start with tariffs right here. What we're showing on this chart is taxes on tariffs relative to overall tax receipts. And a couple of points here to note. Overall, tariffs are a pretty low proportion of tax receipts. So it's not a big mover overall for actual dollars. However, you can see in the first Trump administration, in that 2017, 2018 timeframe, we did have a material spike in tariffs. And so what we're looking at as we think looking forward is whether those tariffs are going to be more of a negotiating tactic to bring trade partners to the table, and whether they're going to be a little bit more targeted tariffs, really trying to alter behavior on very specific goods. Or on the other hand, if these are going to be universal tariffs across multiple trade partners that incite a trade war, we feel like that scenario could be very inflationary and it's a material risk to inflation. Whereas the first scenario I outlined is much more of a minimal impact to inflation. Either way, I think what's important for everyone to remember is that if you have an impact with tariffs on inflation, that's a one-time bump up in the increase of the price level, and then that becomes the new price level. So rather than thinking of it as this out of control spiraling inflation, think of it tariffs as a one-time reset. So that's what we're watching on the tariff front as we move forward.
Well, that's helpful to understand the kind of temporary nature of that inflationary pressure from tariffs. But the other item you mentioned at the beginning of that was immigration. And Jenny, why don't you shed some light for us on what the immigration policies of the incoming administration might do in the way of inflationary pressure?
Absolutely. Well, I think it's clear that the main policy proposals coming out of the new administration, if they are enacted, would create inflationary pressure. I do think it's important for us to recognize that there is a humanitarian element to immigration policy that's important. But in this setting, we're really here to address the economic effects. And ultimately, a government proposing shrinking of labor force is inflationary. It creates wage inflation. So this chart shows just how critical immigration has been to driving population growth over the past 5 years, and how it's projected to be the sole driver of that growth as we roll the tape forward. Estimates suggest higher immigration boosted payroll jobs by 70,000 jobs a month. And that was in 2022. That number is yet even higher, closer to 100,000 jobs a month in 23 and 24. Ultimately, if we decrease the labor force, either through deportation or stricter immigration laws, it could cause inflationary pressure from the bottom up.
Well, as an investor and a consumer, as we all are on this call, certainly starting off with some of the inflationary pressures that could be coming from this new administration is concerning. I'd like to take it back to that original question, Andy, of the inflationary pressures from new policy changes. And what are some of the things you see that could actually counteract those pressures and maybe be a little bit more bullish for markets?
Yeah, it's a great question. And a couple of the opportunities we are seeing right now that could be disinflationary forces, kind of keeping a lid on inflation for years to come, are both in lower energy costs and in productivity opportunities. So let's just start with energy. Energy costs infiltrate really all components of inflation. If you think about it, it's part of our food costs, it's a part of our transportation costs, it's a part of our utility and housing costs, it's a part of running businesses. And so if you can have lower energy costs, that can be a huge opportunity to keep inflation low. The simplest way to lower energy costs is to increase the production of energy. We have seen this with the Trump administration, both in the 1.0 administration. They were very bullish on energy production. We're hearing the exact same types of sentiments again in the second administration, in this 2.0 administration. Very, very favorable on energy production. And so we do see that as a huge tailwind opportunity for keeping inflation low for several years to come.
Excellent. That would certainly be a boon to both the global economy as well as the domestic markets. Of course, the other disinflationary measure we hear all the time is increases in productivity. Matt, how are we viewing increases in productivity under the new administration?
Well, clearly the administration views deregulation as a potential for increasing productivity. Bank of America reports over the last 30 years or so, we've seen about 300,000 regulations added that produce about $3 trillion of cost, or about 12% of GDP, to companies. And so if there's the ability to deregulate and unlocking that alongside of a potential technological productivity boom, could see significant increases in productivity while keeping inflation tamed. And as you can see from this chart, productivity increases have been relatively stable over the last about 10 years, absent a shift in the COVID pandemic. And so really going forward is where we see opportunity for increased productivity potentially with some of these things that would help to keep inflation lower. The other component here is that this administration is looking at prominent, private sector business figures and being involved with that. Historically, as you can see from this chart, the difference between public and private sector productivity and efficiency has been significant. And so if we were to get the public sector being run in a more private sector type manner with a focus on productivity, that could be an additional benefit in keeping inflation lower.
Thank you. Well, it's very clear we've got some competing pressures here, right? We've got the inflationary pressures in the form of immigration policy and tariffs, and some potentially disinflationary pressures from lower energy costs, increases in productivity, deregulation. The one thing that's very clear is that this is going to be path dependent, which is a phrase that the Federal Reserve has used numerous times as they've gone through the data. I think pivoting to the Federal Reserve right now would probably be the next most logical place to go. They're the 800-pound gorilla in the room in terms of tackling inflation. And really, what we've described today with this 224 Goldilocks scenario in the economy, it's an economy that in the aggregate is working. But when we peel back the layers of the onion, what we see is that it's been a different story for different segments of the population. And I think this chart right here on household net worth really illustrates how well it's gone in the aggregate. We've seen a $50 trillion increase in household net worth, really going back to pre-pandemic, so just 5 years ago. And frankly, most of that has fallen for the asset owners. So if you owned investments in stocks, businesses, homes, etc., you've seen your wealth go up considerably in just the last 5 years. However, what we've seen is those people who were not the asset owners coming into 2020 have in many ways been left behind by the rapid expansion. And a lot of people went to the polls in 2024 and said, this illustration right here is not the experience I've had. So as we move forward in the Federal Reserve's perspective, Andy, what are they looking at that may change the course of interest rate policy?
Yeah, and that really is the trillion-dollar question, Jeremy. And if we think about how we got here over the last 5 years, it's taken 5 painful years for Fed Chair Jay Powell and the Federal Reserve to get the economy back to that 224 Goldilocks scenario. And, it took inflation going from 9 to 2 over the past 3 years. But look at the unemployment rate, because really in 2024, we started seeing a little bit of shift in sentiment going towards unemployment beginning to increase. Yet over the past 3 or 4 months, we've actually seen unemployment start to stabilize again. So to me, the Fed chairs are starting to look at this as a fairly balanced economy where inflation and unemployment are both equally balanced right now. And so what we believe will happen from here is if we see that unemployment rate start to shift back up higher, we will see the Fed start to take action and look to lower rates. However, if we do see inflation start to accelerate again, I would very much expect the Fed to not only pause interest rate cuts, but even look at resuming interest rate hikes. And so this Fed has shown back in COVID pandemic, in the pandemic in 2020, that they're willing to cut rates to zero immediately. They've also shown they're willing to do the steepest rate hikes we have seen in the last 40 years during the inflation spike. So they will do what it takes to keep this economy at this 224 Goldilocks scenario that we've been talking about. Which direction we see it move from here, that's what's hard to suss out at this point.
Or we both know what they really control is the shorter term of the yield curve. And when they set interest rate policy, it affects those short term rates. And coming into 2025, we really saw that start to play out in some differences between long term rates and 2 year rates, what we call the 2 year treasury spread. Shorter term yields were actually below long-term yields for the first time in a few years after that, 525 basis point hiking cycle that we went through with the Fed. To finally see this switch was a welcome sign. Turning to the impact of interest rates on business investors, Dennis, how does this story play out for the two parties?
Yes. On the short end, when we think about the Fed funds rate and what influences the prime rate, which has also moved down in lockstep, a lot of variable business loans are based on prime. So as that number comes down, small businesses, for example, local and community banks, are seeing a material reduction in their borrowing cost, and this is good for the economy. Similarly, homeowners who find themselves with higher levels of home equity can borrow on home equity lines of credit at lower variable rates based on prime to do such things as home renovations that stimulate the economy and potentially create additional wealth on household balance sheets. But the longer interest rates are more driven by market forces, and we really haven't seen those long-term borrowing costs, especially mortgages, come down. In fact, they've backed up, and this has the potential to bring a freeze or slowdown to the housing market. The housing market, as we know from the unfortunate experiences of 2008, 2009, is a major component of our economy.
Yes, it is. It's very hard to forget those times for those of us that live through them and or investors through them, whether professionally or personally. But it doesn't sound like anything too significant is on the horizon there. The Fed is, of course, keeping a close eye on their impact on long-term rates as well. Um, in addition to that, we do know that housing prices will probably be supported by the complete lack of inventory from underbuilding for years in this country. So, nevertheless, it does remind us that fiscal policy can play a really outsized role in responses to some of these pressures. Of course, that brings us to a conversation on deficits. They've been throughout the news, deficits that we're running coming into this year, but really the deficits have been there for the last 24 years. It's been all the way back until 1999 that this country last ran a balanced budget. Hunter, you and I were recently talking about some of the articles we saw in the Wall Street Journal around the Doge, this new Department of Government Efficiency, certainly grabbing a lot of headlines. But is there any meat on the bone to these uh, policy changes around the federal budget?
Yeah, Jeremy. Well, as far as what's next for government spending, it certainly will be interesting to see what comes out of Doge, although we know that cutting too much spending may not be stimulative to the economy. And also, any decrease in spending may very well be offset with a new tax plan. We see from our chart here that tax revenue on the right side really only covers spending for Social Security, Medicare, Medicaid, and interest payments on the bottom left. Now, discretionary and defense spending on the top left pretty much equals the $2 trillion deficit we see on the top right. To lower the deficit, obviously, either revenue needs to increase or spending needs to decrease. To increase revenue, that looks like either higher tax rates or economic growth. And to decrease spending, that would likely look like cuts to Social Security or Medicare, but neither party has seemed very interested in touching either of those. So, large deficits are likely here to stay for the foreseeable future.
Got it. And you mentioned tax policy earlier. What implications do we see on that tax front?
Yes, on the tax front, the main thing to watch is the Tax Cuts and Jobs Act of 2017 is set to sunset or expire at the end of 2025. The chart here shows the impact to individual rates if the Tax Cuts and Jobs Act simply expired. For example, we see at the very bottom, the highest individual tax bracket jumps back up from 37 to 39.6%. In addition, corporate tax rates, currently at 21%, were also lowered with the Tax Cuts and Jobs Act, and the lowest we've seen in nearly 100 years. And this has no sunset. So higher tax rates could help cut the deficit, but may not necessarily stimulate economic growth. And we may see Congress pass an extension to keep individual rates lower. So while we do expect the current administration to prioritize tax policy, there is a very slim Republican majority in Congress, so it won't be an easy hill for them to climb.
Oh, there's certainly a lot on the fiscal side that could affect our domestic markets this year, and we'll be watching all of that to see how that impacts investment opportunities. Pivoting to the global scale, Jenny, how are businesses navigating the current geopolitical environment?
Yeah, it's a great question. And ultimately, I think the pieces on the board are broadly the same, but as is the case with most things, the devil is in the details. Fiscal flexibility for many governments remains constrained against the backdrop of rising debt levels. There are heightened security concerns that could lead to an increased defense spending, and more expansive fiscal policies could be pursued in an attempt to address some of these concerns around cost of living, infrastructure, all of those could maintain an inflation at a higher than expected levels. The other part of this, as we zoom out on a more global scale, is these protectionist policy agendas that have taken greater prominence as more advanced economies are looking to protect their key domestic industries. Going back to the tariffs and trade conflicts that we talked about earlier, really between key blocs, the US, the EU, and China, that could affect growth and the prices of imported goods and impact trade flows that may be exposed to some of these geopolitical threats.
Interesting. I'm wondering how that might impact the dollar, Matt.
Yeah, well, it is interesting because despite the fact that we've had massive deficits, as well as different geopolitical things going on, conversations around the US dollar no longer being the world's reserve currency. We've actually, as you can see in this chart, seen a strengthening of the dollar, not a weakening. So, currency is all relative. And I think in light of the things Jenny was talking about that we're seeing, abroad, foreign investors and interests are still seeing the US economy and growth rates as a relatively safe haven or flight to safety, where there's some limited concerns around US growth rates and the deficits that do exist.
Helpful. Well, certainly we spent a lot of time talking about the economy, which was a major issue for all voters at the polls this past year. But really, the billion or trillion dollar question that we're all trying to get at is the impact on investment implications. Andy, taking all these various economic issues into consideration, how does this impact markets moving forward?
Yeah, great question. And let's just start with the US equity market. There is a lot to be excited about with US equities right now. When we're talking about low tax rates, right? And we're talking about deregulation, we're seeing very, very strong profit growth with all of the US corporations. Where we have these potentials for productivity booms that Matt talked about, and we have margin expansions that could come through AI technological advances. That's all very, very exciting, right? Well, it's also all priced into the market, as the US equity market is one of the ultimate leading indicators. And so to us, the big question is, where do we go from here with all that optimism, not only out there, but also somewhat priced into the market? And we have this chart here, and what we're kind of showing is the annual return of the US stock market measuring the S&P 500 ETF. It's 3 steps forward and 1 step back typically. Not that it's always that cadence, but just that type of rhythm. And sometimes we have a year like 2018, for example. In 2018, we did have strong GDP growth. In 2018, we did have excellent profit growth. That was all forecasted in 2017, where you saw all the price appreciation. And then in 2018, it just took some time for the market to digest all of that strong profit growth and GDP growth. And then it picked right back up where it left off in 2019 and 2020, as you can see here. And so to me, that's one of probably the bigger risks in the markets right now, compared to the inflation spikes or financial crisis or global pandemics. Of course, those are all unknown unknowns. But to me, the bigger risk is that all of the optimism I just outlined, which is very exciting for not just this year, but several years to come in the market, some of that may already be priced in. It may take a little bit of time for some of that to digest in the US equity markets.
Andy, it's interesting. We went through that long period of time of what was essentially ZIRP, the zero interest rate policies. And for bond investors, it was very frustrating, right? Bonds and the portfolio allocation tool really were just there for risk reduction, or what a professional investor might call beta reduction. Then, of course, we get to that 2022 timeframe that you just showed, where the S&P 500 was down significantly, and the bonds that were there for risk reduction also were down significantly as we dealt with an inflationary spiral, or inflationary event, I should say. As we move forward, that environment's changed a lot. We just talked about inflation and interest rates. What's the outlook for the bond markets in 2025 and beyond?
Yeah, Jeremy, I remember using for several years, we called it the TINA market. There is no alternative to equities because bonds paid nothing. And that just doesn't accomplish, frankly, anything for investors besides lowering the risk. And so all of a sudden, as you can see in this chart, there is an alternative. Now, not only are bonds paying higher yields altogether, they're paying real yields above inflation that can actually make a material impact to client portfolios. So not only can you reduce the risk in your portfolio a little bit, but you can actually get paid on it, which is something, frankly, we haven't been able to do in the last 15, 20 years since the financial crisis. And what's really gotten interesting, as Dennis outlined earlier, is that the longer term yields are finally starting to offer some attractive rates. For the past couple of years, it's just been stay in cash. Cash is paying you more than a 10-year treasury. Why would you buy something that is a long duration income producing asset? Well, that dynamic has finally changed. And so we are starting to see some interest in bond markets. We do feel it's a great time to be a lender. Overall, as we've said, the economy's healthy. Corporations are healthy balance sheets. Consumers overall have healthy balance sheets. And so we are seeing some opportunities in the bond market for those high quality, longer duration income producing assets, it is starting to look like an opportunistic time.
Of course, the other item that's out there that we haven't talked about yet is the global stock market. And probably haven't talked about it for good reason because for the last 15 years, no one's really wanted to talk about it, right? There's been only one game in town. You talked about it before, Tina, and that was the S&P 500. Absolutely trouncing foreign stocks going back to the global financial crisis. But that's over 15 years ago. And as we look forward, are there opportunities in foreign markets, Andy?
Yeah, that's another great question. And, when we think about foreign markets compared to the US, there's really two things that come to my mind about where we've been. First and foremost, the US has what they've been calling the Mag 7, these big tech stocks, and frankly, foreign markets just don't. So if you just strip that out, then really US equity markets and foreign markets are much more similar in nature. The second thing is really what Matt was talking about earlier, the dollar strength. And so if you own these foreign assets that are priced in yen and euros and pounds and so forth and so on, then you have experienced a decline in the dollar value of those assets, even though within the local currency, those assets are producing very, very well. And so what this chart here is showing you is that we're actually seeing the largest valuation discount from US markets to international markets that we've seen in this really in the 2020s, in the 21st century for that matter. And so not only are you able to buy these foreign assets at a discount, the largest discount to the US that we've seen in the last 25 years, you're also doing it at the same time that the dollar is at all-time highs. So if you have any type of value mentality at all, we do think this is starting to get an interesting time in foreign markets. Of course, the US has shown all that strong growth relative to foreign markets. Of course, there is a lot of tariff risk, but it kind of goes back to that conversation we had with US equity markets. Is that priced in? We think that yes, a lot of that is priced in. So that does offer some upside opportunities to foreign markets if any of that changes. But as we just said, they don't have those magnificent seven companies. So if the trends continue that we've seen in the past, there is still that risk that foreign markets underperform. But based on everything that we're seeing today, it is a place that we're finding interesting right now in markets.
Gotcha. Well, kind of landing the plane here, bringing everything to a close. I heard you describe the U.S. markets have done very well, often as a leading economic indicator, and we've got a great economy, as we touched on at the top of this call. Opportunities to be a lender right now are the highest and strongest we've seen in a long time. And for the value investors, foreign stocks are starting to look attractive as sentiment and valuations are quite low. Let's land the plane here. How should investors position their portfolios in light of all these comments you've made today?
Yeah, there's really a few different places that we've been emphasizing in client portfolios as we've been allocating capital and looking out ahead. First and foremost, we think this is a critical time to be focusing your equity investments on profitable, cash flowing, and growing businesses with reasonable valuations diversified across industry, region, and size. We do think right now it's important because there's a lot of stories going on in the market. Every headline is a story. And so we think it's really important to make sure that your equity investments in particular are driven by strong fundamentals and not just the good story alone. It's great when those two come together, but it's really important to not just invest based on a good story. So we really want to emphasize that. We also think, like we talked about with the bonds, we want to go long in those income producing assets where we're starting to get some really compelling returns and we can kind of lock in some of these compelling yields that we're seeing right now that we haven't seen in the past 15 or 20 years. Stay flexible. We're back to what I kind of call that tweet volatility era where one message, one tweet can significantly move markets. So stay flexible, be ready to seize opportunities as they come in markets. Don't forget, market corrections are normal. The average drawdown in a year is 14%, and yet we didn't have one in 2023, didn't have one in 2024. Like I was talking about with that digesting, there is quite possible we will have the market digest at some point in the next couple of years, and that is a normal part of the process. Sometimes the market just needs to digest all of the good news that has been already priced in. And then finally, Most importantly, let's align that investment strategy with your risk tolerance and needs. We like to call it the two front battle. We want to fight that short term volatility, those short term cash needs front. We want to make sure we're not having to force sell in any down markets. We can weather the storm with that short term horizon. But just like we talked about at the very beginning, Jeremy, it's important to also fight the battle of long term inflation. We need those assets in our portfolios to grow and outpace that long-term inflation so we have that money when we need it for the decades and years to come. So really where we're trying to be at this point as we look out ahead is right at the intersection of where discipline, flexibility, and opportunity all come in line.
Well, thank you for that insight today, Andy. That's been very helpful. I want to thank our advisors as well for their insights on the call. Most of all, I want to thank you for joining us. If you have any questions about anything we've discussed today, perhaps how it fits into your financial plan or how you can take advantage of some of the opportunities we see unfolding as we move into 2025 and beyond, please feel free to reach out to us. We can be reached at 615-370-1253 or by visiting our website, sevenspringswealth.com. Thank you. See you soon.